So Heath, thank you for coming back here again.
Of course.
And appreciate the support as always. So can you talk a little bit about your current portfolio today? Last time we had you here, you just moved from Midstream, where you created a nice $2 billion EBITDA business for Phillips 66, and you came into emerging energy business. And I was saying that every time Phillips 66 wants to find $2 billion in EBITDA, they come to you. So no pressure here.
No pressure at all, right? This is a different space than Midstream. It's a little more difficult.
Difficult, yeah, of course. And since then, you've focused. I think you spent some time starting up the emerging energy organization, but then now you've moved into a more focused role, and I'm assuming Rodeo is a big part of this. So
it is.
I'll let you describe what you're currently working on.
Yeah, we've kind of been on this journey. I'll start with, just hearing what you guys had to present here. We agree with a lot of that. We see where the world's going. Heard other speakers talk about this transition is going to be difficult. A lot of these projects are challenged, whether it's in the carbon capture space. And some of that challenge is you have the not in my backyard for our traditional business. It's exactly the same we have found in energy transition. Nobody wants the turbines in their backyard. They don't want CO2 pipelines. Even those that are as green can get, they still don't want it in their backyard. So a lot of the challenges are the same. Some things are different though, in that was truly more a capital market. It was efficient. It was driven by actual real market incentives. Now everything we're chasing really only works if you've got artificial incentives layered on top of that. And so Phillips has kind of taken a view of how do we participate. We always talk about this is a story of and, right? We're going to keep doing what we do, right? We're a traditional refiner, 2 million barrels a day of processing. We're going to keep doing that. We're going to find ways to do it better, more efficient, and we're going to find ways to participate in energies of the future. We've been going through an energy transition since man found fire, right? It kind of happens over time, and it doesn't happen in a year or two, though, right? It takes decades to get there. We've transitioned, coal dominated the energy landscape for a long time. We've transitioned to other fuels. We still consume more coal today than we ever did, right? So we have to understand, how does that work? And anyone who thinks that we're going to transition off fossil fuels in 10 or even 20 years, they're just bad at math, right? It just doesn't work very easy. And so we're trying to find ways to do it. And so after the Midstream role, I actually led our corporate strategy group. And we looked at a lot of different things we could do portfolio-wise. We knew some assets weren't going to be long-term in our portfolio. Other ones we thought we could repurpose, like Rodeo. But we were also dabbling in it a little bit, right? We had already started processing used cooking oil at our UK refinery. Right? We were the first ones to actually produce sustainable aviation fuel, and we provide it to the Heathrow Airport and sell it to British Airways today. We already produce a lot of specialty coke material, and we have for decades. But it's now become one of the key materials in lithium-ion batteries for the anode production, right? So we said, okay, we're doing some of that. And so for about 2 to 3 years, we were pushing our executives to say, make this someone's day job, right? We've got our refining system, we've got chemicals, we've got midstream, we've got marketing. And so then they asked, the EVP, he came by, he says, Heath, you're the latest example of if you complain about it long enough, you get put in charge of it. So they asked me to start up the emerging energy group. I grabbed about 6 people from around the company. In that first year, so this was, it was just about 2 years ago we started. In that first year, you had to kind of run parallel paths. One, you had to learn, right, who you're going to be when you grow up. To develop a strategy for emerging energy, we had to really think about where you're going to play and how are you going to win, right? We've had a lot of consultants come tell us how much money is going to be spent in this space. You've seen numbers of $3 trillion a year if you want to get anywhere close to the targets the world's setting. The comments we hear is there's going to be trillions of dollars spent and trillions of dollars destroyed. So how do we make sure we're not those guys? But at the same time, the market's not going to wait for us. And so we came out, we felt about, okay, we know there's some things we can do, right? How do you separate good ideas from good ideas for us? And we knew that we make a lot of CO2, so we can talk about CO2 capture. We produce and consume a lot of hydrogen, right? We participate in the battery value chain today. And certainly you think about renewable fuels, we're very heavy in that already. We were actually turning cow fat into diesel in Borger, Texas 15 years ago, right? But then the government changed the incentive from $1 a gallon to 50 cents a gallon, and now the math didn't work anymore. So we're kind of aware of how that works. So we started stepping out and trying to place some smaller bets. We actually had our first deal done within about 4 months, investing in a soybean crusher plant where we get all of the offtake of the soybean oil. And we're even looking at finding ways to make it lower carbon intensity soybean oil based on regenerative farming. And then using that for part of our feedstock for Rodeo. We invested in a new battery anode facility in Chattanooga with our partners Novonix. You think about trying to drive towards EVs, 95% of all anodes for those batteries are made in Asia, most of them in China. Right? So localized supply chain, how do you deal with that? So we're trying to participate there. And then hydrogen, we went out and invested in, this was just this last summer, formed a joint venture to build out 250 heavy haul hydrogen refueling stations in Germany, Denmark, and Austria. Right, now none of these are portfolio riskers for us. Right? We can do those. But as we spent that first year, we kind of got stood up. We felt good about those kind of 4 different areas we wanted to play, really talking about how do you extend your existing value chains, leverage the assets you've got. You know, solar in India might be a good idea for somebody. It's not a good idea for us. So we felt we got that, and now we said, okay, but they're on different time tracks, right? Renewable fuels, go big, go now, right? In fact, I'm of the belief that, especially on the renewable diesel side, you'll see that built out probably by 2030, right? You're gonna have enough. In fact, California today, the entire on-road diesel consumption in California today, 50% of that almost is renewable. Right, so California's gone that far, that fast on road. I agree with the comments before about sustainable aviation fuel. You know, the last number I saw from Platts was maybe you get to 20% of the jet pool is SAF by 2050.
Yeah,
it's just hard. The other ones, hydrogen and EVs, certainly looking at carbon capture, you can do stuff today. It's just going to take a while to get to the same scale. So we kind of had a bit of an adjustment. They've asked me to kind of build out the renewable fuels team. And really try to see what can we do to go bigger and go faster there. So Rodeo is the first big project. It's already partially converted. We're making about 10,000 barrels a day today of renewable diesel, which is one of the largest facilities in the world. When we're done, it'll be 50,000 barrels a day. And very, very much capital efficient, right? In order for us to keep doing what we're doing, we have to satisfy our shareholders. And they still want to see those returns, right? Yeah. This is not a nonprofit. We're going to be able to do that project for roughly $1 billion for 50,000 barrels a day. We see a lot of the smaller startup companies coming out, some of them doing e-fuels. They're spending $1 billion to make 1,500 barrels a day. Now, it still may pay out with the right CI, but if we think about our motto of providing energy, improving lives, and it's not just about did you get the return, right? If you're really trying to decarbonize, we think there's a better way for us to spend $1 billion than on those small volume projects.
So, you know, if you look at the intersection of oil and gas and renewable fuels, right? I mean, Valero made a big bet very early on, 10, 15 years ago, by acquiring POET's ethanol assets, and then Marathon's acquired some ethanol assets. Chevron recently bought REGI. And then a couple of renewable natural gas deals. Is Phillips's strategy mainly going to be organic growth in renewable fuels, or? It'll be
a combination. There's a lot of repurposing, right? What we're doing with used cooking oil in the UK, that cost us maybe $20,000 to get that up and running. It's like nothing, because you have the massive kit already there on the ground. You're just co-processing. It's Sweeney, Texas. You know, we're actually running pie oil. I know that was on your agenda as well. Pie oil from plastics, again, costs us almost nothing, and we're able to integrate it to our value chain. We have our JV partner CP Chem right next door, so we're able to provide them with the olefins we generate from processing that material. So it's a combination. I mean, we have so much kit on the ground that we absolutely should look there first. But we also talk about, in order to make sure this is going to work, you have to have like 4 or 5 things where you can say, okay, do I have the right partner? Because you can't do it all on your own. So we've talked to some ethanol producers. Do we have the right technology? A lot of folks are talking about alcohol to jet, but there's different ways to do it. And I think there's technically, SAF has like 7 or 8 different approved pathways. Do you have the right location? And that could be, right location could be, well, if I've got a CCS project, the location may be I just need the right geology close by. Or it might be I need the right location. Maybe SAF is good because Illinois just passed this new SAF incentive up to $1.75 a gallon. So maybe being close to that's a good thing. So partner, technology, location, and certainly the right returns on the project, right? So we think we can do those things, and there'll be a combination of finding the right partners, leveraging their assets, or leveraging our assets and what we know. And we always come back to, this is just This is molecules and electrons. We're good at those things, right? A refinery is a refinery. It doesn't mean it has to be a fossil fuel refinery. We can refine other things. Anything that's hydrocarbon, you can make diesel and jet fuel and renewable gasoline out of. Right? There are processes where people are taking used cardboard and they can find ways to do it. It's just not very cheap.
So it sounds like a strong, I guess, a strong reliance on a predominantly organic strategy unless the right opportunity shows up. So seems to be what I'm hearing.
Yeah, I mean, I think so. And we heard earlier about access to financing. A company our size, we have some different options there. We're not seeing any shortage of people knocking on our door wanting to invest in our projects.
Yeah.
There's plenty of people out there with money that want to come invest in these kind of projects. But again, you got to have the right partners and the right reasons. And typically, we don't want just a financial partner. We want more of a strategic. Sure. They bring something else to the table. But we also have to get creative. We have a new board member. We were talking about, how do you do off-balance sheet financing? We've got certain targets we shoot for our different debt ratios. Mm-hmm. So how do you do things that maybe are off-balance sheet JVs, don't consolidate, and leverage it? We have some projects we're looking at where we think we could grow 500 plus million a year of EBITDA. The project might be, a typical 7-8 multiple of that, so maybe a $4 billion investment. We only have to put in $1 billion, right? And so it looks like it's a 2-build multiple when you're said and done. And so we try to do that, and our board member, he says, where he used to work, he says they called that opium, other people's money. Right, and so we got kind of stuck. I don't know what the other letter stood for, but so we're trying to find ways to be capital efficient. We have our shareholders, and one challenge we have is, people that buy Phillips stock, they want ratable dividends. They want certainty of the cash flow, mm-hmm. right? They're not looking for us to be some high-risk enterprise. They don't want us to take the Tesla model where we're going to spend a bunch of money and have no profits for 10 years. Yeah, we don't have that luxury. That's not who owns us, and so we have to find ways to find that middle ground, to show the value of the diversification, right? We understand where traditional refining is going, right? We agree with your thoughts on, gasoline's probably peaked, or if it hasn't, it's getting pretty close. Mm-hmm. And so how do you make sure you're diversified, leveraging what you're good at, and finding ways that we have a long runway of value for our shareholders? We don't want to go into just a simple harvest mode. Yeah. Right? And we firmly believe if you actually want to see this energy transition, it's going to be your traditional energy companies that are good at building these kind of assets. They're good at operating assets, mm-hmm. That have the balance sheets to support these big projects. So we want to be there, and we want to just position our company to have those options to invest as the world evolves.
So 50,000 barrels per day, that's a lot of renewable feedstock that you need to
Or
fill.
800 million gallons a year, since I like to talk in those numbers. Yeah. I'm having to retrain myself.
Yeah, I know the renewable fuels industry loves gallons.
Sounds more impressive, right?
All of us who grew up in refining love barrels per day, and
yes,
we have to keep doing the unit conversions fast enough. What do you think of finding all that renewable feedstock to fuel, I guess, Rodeo?
So we look at different value chains, and so we go through each one of those, whether it's hydrogen, batteries, carbon capture, and I'm a big believer in any business. If you look at the value chain, you better make sure that whichever link you choose not to participate in isn't the pinch point, because that's where all the value gets sucked out. So on the battery side, we're not looking too much at the cathode, and we're probably not going to be the ones who actually make the finished packs of the batteries, because that's just not where we belong. The other ones make sense. In my area now, in renewable fuels, I look at renewable diesel and SAF a little bit differently. Renewable diesel, I think you need to be on the feedstock side, since hence we invested in the soybean crusher plant. We've looked at other investments. And you better be in last mile, because if you're just selling it at the rack, they're going to extract money from you there as well. So we've made some significant investments even in the retail side in California, because we want to be in every link of that value chain, because otherwise it's gotten quite sophisticated and people will extract value from you. They know what the LCFS credit is, what the RIN price is. So you have to have that. SAF's a bit different, right? Depending on how you're making it. If it's more alcohol to jet, well, there's plenty of ethanol around, right? In fact, as gasoline demand goes down, so does ethanol.
Yeah. We are exporting a lot of ethanol right now.
That's right. Yeah. And so we have positions at over 100 airports in the United States. And so we have that infrastructure, and it's just different, right? You're selling long-term contract, typically a year contract to the airline. It's not like trying to sell diesel every day at the corner station, right? So it's a little bit different on both sides. But to get back to your point, I especially think on renewable diesel, the HEFA-based, right, that we're looking at here, whether it's veg oils, cooking oil, tallow. We think that we identified that as a critical risk before we even approved the project. And so we've got teams that do nothing but go out trying to gain positions. We've got offices in Singapore. We're aggregating material in Rotterdam. So it's absolutely a focus for us, and it's also why we built or are building some very sophisticated pre-treatment units. So we can pretty much run anything people can bring us and turn it into diesel. But it's kind of like refining. If everybody builds the same pre-treatment, and one thing our industry is really good at is overbuilding. So if everyone builds the same thing, it'll be like if everybody has a coker and heavy processing, then all of a sudden your light, heavy discount and crude oil isn't there because it's not special anymore. So we're having to kind of watch the market and adjust and decide just how much capital do you have to put into that link of the value chain to get the feedstock security you want.
So it seems like Rodeo, it's also leveraging some of the long-held competencies in refining technology, process technology, where you build out these pre-treatment units that give you flexibility on the feedstock side.
Very, very much so.